Good evening, friends. Welcome to this weekly edition of Thunder Thursdays. I'm your host and host, Dr. Bhavdeep Ahuja, before you with the episode number 22. I'm late by a couple of minutes today. I'm sorry for that. The only reason, of course, getting free late from the clinic. So let's waste not much of time in the introduction and straight away get to the topic for tonight. Let me just check whether I'm live or not, and then we can start. Straight away get to the topic. Yes, I'm live. So allow me to share my screen and begin with the proceedings. Okay. So this is today's Thunder Thursday live, and I am before you presenting the 22 episode number 22 with a very commonly asked topic that I keep on getting questions on in my WhatsApp community, where you can say I'm taking a lot of sessions, especially on Sundays, and of course in the weekdays whenever the time permits. So let's begin today's session. And as usual, all my presentations will always begin with thanking the Lord Almighty has given me much more than what I deserve. And when it comes to finance, of course, big thanks due to my dad as well, who has been instrumental in teaching me the clinical part of finance. So this is my brief CV. You all are aware of it by now. Let's go to today's topic. Today's topic is how to choose the right mutual fund scheme. Funds to choose from as of last you can say count. There were close to 1,400 mutual funds in the Indian mutual fund industry. Of course, it becomes very confusing because we have a lot of advisors giving us an advice to select whichever fund suits their sensibilities. We are not actually, you can say, clear about the opinion part. So, of course, this presentation can be divided into two parts. The second part I can take up next time. It'll depend upon the interest shown by the audience. If the interest is a lukewarm one, then of course I'll be taking up the different topic in the next session. But if the interest is great, and I find a lot of people watching this session and you can say sending me feedback, surely part two of this would be there. So let's begin today's topic and go about how to select a, you can say, a mutual fund scheme. So normally when you ask someone that how do you pick up the restaurant when you have to go for a meal, what are the common things you will consider? Number one thing is what you would feel like eating. You want to eat Chinese, you want to eat continental, you want to eat Thai, you want to eat Mughlai, you want to eat fast food, you want to eat junk food, or you want to have a proper Indian meal. You will consider that first. Number two would be the budget part. You want to end up in a fine dine restaurant, or maybe a normal one, or maybe you can say a rustic dhaba. So it all depends upon that also. Then, of course, once you have jotted down on the first two things, then the third thing is always you consider that number of you can say people have given the reviews for it. Of course, this is the new world today, especially after COVID. The online world is full of recommendations and you can say reviews people are putting up on Google or any other food sites. Of course, even on Zomato and Swiggy parts, they allow fine dining as well. So they are giving the reviews over there. So keeping in that mind, you would choose one restaurant that would satisfy you the most. If you're not able to, then you will obviously end up eating at your normal dal roti or sabji at home. So these are the things that will, you can say, decide the choice of the restaurant. You won't say that I will straight away go to the, you can say, if my friend tells me go to ABC restaurant, I'll go over there. Let's suppose it is a fine dine restaurant serving, you can say, fast food and of course Indian food, but not the Chinese or the Thai food. I'm in a mood to eat an Italian or a Chinese or a Thai food today, and the restaurant doesn't serve it. So what use is that? Similarly, if somebody is suggesting you mutual funds, if those don't suit your sensibilities, don't align with your goals, what is the fun of those mutual funds? Of course, the similar fund approach can be used to track a mutual fund as well. So this investing requires patience, efforts, as well as the risk appetite, surely. So because the mutual funds will offer you various benefits like diversification, like asset allocation. Diversification is actually choosing from different asset classes. So these all have to be taken into consideration. You don't want everything to be put into equity. Equity, the you can say the funds which are based on the stock market entirely. Of course, that carries a risk as well of your investment going, you can say bust, or even you can say going down or growing at a slow pace, giving you a negative return for a good amount of time, and when you need the money, it might not be available to you as well. So these things may happen with the equity investment. So that is why a balanced approach is always recommended for such situations. So you can say choosing mutual fund might look easy, but of course, if you don't have the basic criteria, how are you going to fulfill those things? So what are your basic criteria? The number one criteria, as I gave you for the example for a restaurant. So identify your goals first. Look at your risk appetite and the ability to invest. Of course, your budget timings and how much risk that you can take to put in the money over there. Then, of course, finding a fund that meets your needs and checking if the investment style and strategy will help you reach your goal, fund's past performance history and the expert reviews, and of course, the fund fees, expense ratio, and other valuation factors. So people who are just investing on hearsay, they need to check out all these factors for a particular fund, even if somebody has recommended you a particular fund. So remember, it is not like that you go and just simply buy a mutual fund. It has to be on your goal strategy first. I'll give you a particular few situations today, which will guide you that what you all have to do as per your given situation. So let's see the various scenarios. I'll be discussing it in a scenario-wise situation. You want to invest in the best mutual fund, of course. This is the first situation. So you want to generate, you can say, a long-term wealth. Obviously, a good approach would be to pick up the funds that are investing in high-quality stocks, and that will include the blue chip funds. So these funds are investing in blue chip companies with a good historical track record. Of course, they are known to provide good returns over a long period of time, and of course, less volatile during rough markets. Presently, we are having a rough market, and almost the 6 months is we are into the half of the calendar year of 2022, and the markets continue to be choppy. One day they rise up 1,000 points, the next 2 days they are down by 400, 500 points. So this thing is going on, and as the scenario seems, this year is going to be a choppy year when we might not actually see a good growth in equity. But then, fair enough, market runs in cycles, and we all have this situation running up in cycles. So, if after even you can say whatever bad time we had during March 2020, April 2020, during the COVID first lockdown, it was all reversed by August, and even then the market continued to soar new heights and touch good heights by December 2020, went on further to scale a new mounts in April, May 2021, even at that parallel time when the second lockdown was in place, went on to surge on further June, July, August 21. And finally, the market touched its peak on, you can say, 18th of October 2021, when the Nifty touched about 18,400, 300, and the BSE Sensex touched around 62, 63,000. So those were the times which were the almost the peak time. But since then, the market has been down 10 to 15%. So yes, it is volatile. It is going up, going down, but that will continue to happen. That is the inherent nature of the market. So then, if you are willing to invest in the best large cap or blue chip funds, as I gave you an example of the good options, of course, you can't time the market. So the best way would be to go via the SIP route, since they are the equity funds. Then obviously the time horizon should be minimum 5 to 7 years. Now, the second, you have a lesser risk appetite. You are a conservative investor. You have invested throughout your life in the FDs, or you can say fixed income products. But now you want to, you can say, explore equity markets. So I would always say somebody who wants an equity exposure should identify the risk appetite first. 10%, 20%, 30% of your capital. Of course, you would require something which will give you relatively stable returns. So pick up an equity fund accordingly. So for you, maybe to start with, a hybrid or a balanced advantage fund would be a good option to start with, where the risk and the return are both balanced. And then the second would be the index fund for you. These are low cost mutual funds which try to replicate the index. You can say the Nifty index is made up of 50 stocks, Nifty 50. So the index funds are primarily invested in those stocks only. So the benchmark, it is the benchmark actually. The main stocks are there, and any fund that beats the index is of course known to be a better performing fund. But then if you want to balance out the risk and the reward, the index funds would be a good choice. Again, little bit on the higher side, large cap are also an option if you invest in top quality stocks. The route should again be the SIP route only. You don't burn your whole money, you don't burn your whole investment. You need to average out. SIP always gives you an advantage of averaging out your investments, plus it inculcates a disciplined approach in you. So choosing the right mutual fund is not at all a big ask, only if you are very much considerate about it. Of course, a few factors can be rankings, past performance, expense ratio, duration, taxation, performance against the benchmark, fund manager who's handling experience, and the risk factors. Now, the third scenario is you want to invest money for the long term. So obviously, equity, when it comes to long term, nothing beats equity. So equity mutual funds will give you the best return. Of course, they will be prone to market volatility. There are funds that have given you, even if we talk on the year-on-year return from 2020, there are funds which gave even 125% return in 1 year, if we're talking April 21. Of course, you have to understand where the market was at that point of time. It went down. It went down almost by half. So if you consider those things in mind, probably take out 40%. Still, the returns were close to 25 to 30% if we ignore the downfall because of COVID-1 lockdown. So equity 25 to 30% return is a huge one, and that did happen in the past 2 years. Of course, so many funds touched their peak. And of course, we need to be aware of certain things that we are investing in right now in a down market. So this is a approach where you can go in with a staggered approach right now, where you can invest in parts in today's scenario. So if you want to invest money for the long term, a combination of mid cap, small cap, sectoral, thematic funds are good options. Of course, they are slightly risky. They come with an inherent risk more than the large cap ones. And of course, they are volatile more in the short term. If your time horizon is a little longer, then of course a portion of these can give you a good bet. So of course, if you're a conservative investor, don't go in for even the mid cap or the thematic or the sectoral funds or even the small cap. Surely not. Then the large cap or an index fund would be a good choice. Now, the fourth scenario, you want to create wealth for long term, and of course, you're willing to take the risk for it also. One who has a high risk appetite and a thirst to generate high wealth, they can be called as an aggressive investor. Of course, you will then identify the situation to meet that goal. But then the thing is, if you are looking at after 1 year, 2 year return, sometimes you feel, यार बोला तो अच्छा फंड था मेरे को फंड मैनेजर ने मेरे फ्रेंड ने या इवन डॉक्टर प्रदीप ने, लेकिन the fund hasn't turned out to be good because you are invested in that fund, which is a fund with a high volatile situation, or the market maybe in a high volatile in the short term. I told you earlier also, the markets work in cycles, and if these things are not you can say taken into account, the primary condition for creating wealth is to, of course, go in for the long term part. Don't look at your investment for the next 5 to 7 years minimum. Don't even look at tracking them. Of course, track them up if they are not still performing after 6 months to 1 year also, and the rest of the index is performing, then you may think of replacing that. But otherwise, give it a long road. So obviously, as I said, the long term is a better approach. But then if you're creating wealth also, you need to have a combination of mid cap or small cap also along with that. Of course, sectoral and thematic funds can give insane amount of returns sometimes if those sectors become the favorite of the market at a particular point of time. Obviously, the SIP route would be there, and of course, if you can say timing is such, you can time it a little bit. Of course, you can't fully time it. Little bit that yes, it is on the downside now. It is maybe close to the bottom part. Then maybe you can go in for the lump sum also. If you are looking at a longer time horizon, so even that time would be good, because eventually in the long term of 5 to 8 to 10 years, any investment done in lump sum, even today, let's suppose the market is booming, would be anyways considered as a wise investment this time. But then we all need to understand that some things don't align with our goals. As dentists, many of us complain of not having a free flowing income. The problem is not the actual income, the problem is the white income. We all have a good income. The only thing is we don't SHO, show. Show is the key word. And one who starts showing, we all should know that you can invest in white also. If you're filing a 5 lakh rupee return, IT return, so there is no point in even thinking of any kind of investment. So that is the reason whenever somebody wants to do a finance workshop with me, I always insist on understanding the taxation part first, because that is the basics. Apart from the other basic, the banking basic, accounting basic, other things, unless you are not knowledgeable income and what exactly are the deductions part, you will never understand these values. That is the reason people always find नहीं सर मुझे तो इन्वेस्टमेंट के बारे में सीखना है, मुझे टैक्सेशन से कोई मतलब नहीं है, मेरा तो सीए कर देता जो कर. I said no, I'm sorry. If you want to learn an advanced thing with me, even you can say up to as good as if you want to learn F&O with me, you have to go through the taxation part first. I don't teach people who have not done basics with me. If you want to drive a Ferrari with me, you have to learn to drive a Maruti with me also first. So that is the criteria I give it usually. Then the fifth situation is that you are investing for your child's higher education, maybe for abroad. So parents look at this timeline of maybe 10 years, sometimes maybe 12, 15 years as well. Of course, equity funds are surely, but then the goal should be done with a reverse planning in mind. The reverse planning is, let's suppose you intend to have a corpus of, let's suppose 1 CR, inflation adjusted, I'm speaking about. So I need about, you can say in 12 years time, my son's graduation, my daughter's, you can say higher education is due. So let me just arrange 1 CR. If it is due after 12 years, you will do a reverse planning for 10 years, 1 to 2 years minimum. Of course, equity in 10 years can give you insane amounts. Even if you want to, you can say you're doing the SIP way as well. So you give your money the time, because when it comes to time, I always say your time is your most valuable asset. You can't even compensate for time with double the amount. कोई आज let's suppose 2000 महीने का डाल रहा है for 10 years, और कोई 5 साल बाद 4000 महीने का डालेगा for 5 years. At the end of 10 years total from now, their amount would be the same, the principal amount, but their corpus, what their matured amount would be hugely difficult, hugely different. That I've taken up in one of the 2 previous webinars as well. So equity mutual funds beat inflation. I told you some good funds. If we ignore the downside of the COVID 2020 first lockdown, let's ignore the market did not fall. Even then, year on year return, considering what they were in the start of and the end of Feb 2020, the funds have given more than 25 to 40% returns. There are funds. Of course, otherwise, if we consider the March April return, the funds gave 125, 130% return. So, of course, that was a situation we can't call it as an exact indicator. But then the best would be to choose a large cap, which is a time tried and tested results. And of course, there are social rented schemes for children's higher education as well. But yes, nobody should go in for the lump sum part. Lump sum may be topped up in that scheme if at all the market corrects itself by more than 10%, I would say, as is the current scenario. Presently, the market corrected itself by 15%. Of course, the volatility is going to continue till the, you can say, the latter half of the year till Diwali. We expect that same to be there. Probably after that, things may get better. That is the only option. Of course, once you are done with your corpus in about 10 years' time, then switch to an arbitrage or a liquid fund, or you can say a debt fund, or maybe you can keep it in a high earning savings bank account 1 to 2 years before the goal. So that by chance, if your kid's education was due in 2022, at presently the funds have corrected more, the market has corrected close to 15%, and the fund value would be down in March, April. You actually lose out on the returns part. So don't look at the time horizon of withdrawing it immediately before the need, but actually when it is needed. When you can say fund for your child's education, or you can say you're choosing a scheme for your retirement, or maybe for buying a new house, you have to go the SIP way. And of course, identifying your goals is one of the free criteria. One of the first criteria, along with the risk appetite. Because some people don't have the risk appetite of putting into the courage to put into the market part. So then, of course, the sixth criteria, they want to invest for your retirement. That is one thing we all need to understand and put in our brains with, you can say, a lot of hammering in our brains, except for a few people who are working in government colleges. None of us is going to have a pension in our hand. So when you're not going to have a pension in your hand, who is going to fund your retirement? I don't expect us to be working with the kind of, you can say, demanding dentistry that we are doing. At 25 years is a good time to burn out. So I would say if somebody started with a peak practice or a reasonable practice at the age of 28, 30, 55, 56 age would be a good age to retire yourself. And considering an Indian's life is 80 years, you have 25 to 30 years time after that to live on the amount for those. So for that, you have to plan from the first day of your practice, or rather even before that. Because retirement planning would involve accumulating a corpus, which is going to give you a good lifestyle even post retirement. Of course, the best would be again the large cap funds or the retirement oriented schemes, which are, you can say, meant for this purpose. Predominantly, the national pension scheme is one of the advantage. You can say even that is a mutual fund based schemes only, a kind of a balanced return scheme. So, of course, when you're about to retire, you can switch your 1 to 2 to 3 years before to a liquid fund or a high earning saving bank account as per your decision. But as I always say, even when you retire, some portion of your maybe 15 to 20% should continue to be invested in equity as well, because that is going to give you good returns, and that is going to give you the advantage of compounding as well. Plus, it will make sure that you continue to beat the inflation, because at that age, you are not going to have huge expenses. Your primary expenses would be the medical expenses only, which is a part and parcel of the old age, I would say, or the late middle age, considering we as dentists do not actually concentrate on our health, being our even in spite of being healthcare professionals, we don't even look at the health as a vital parameter, which is so vital for a dentist. Our necks and backs are ailing and failing, you can say ailing and frail at the age of 45 to 50 itself. So we need to fund our retirement corpus. We need to keep this thing in our brain. Nobody's going to fund that. It is very difficult to ask for money from your kids at your old age. That is one of the worst things anyone can expect in your life. Then number 7 criteria, you want to invest a lump sum amount. Every second day I get this message from one of my WhatsApp community members. My dad has gifted me this amount. I received this amount. This amount from FD is due. My monthly income scheme has matured. Blah 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 blah. Whatever way, I've got a lump sum. How do I invest? So of course, you can't time the market. You can't enter it. Of course, this is a good time to enter the market, but still for a lump sum, I would say still have a staggered approach. Staggered approach means you can invest in chunks of 10 to 15% of your lump sum amount, and accordingly going on in the equity market space. Of course, for a short term, when you can't time the market, maybe liquid funds, debt mutual funds, or a high earning savings bank account is the option to go. But then if you know the market is bottoming out, it is near very low, take guidance, of course, and you can choose the equity fund of your choice. Or the another way is to do a STP, systemic transfer. Then the last scenario is you want to invest your retirement corpus and also withdraw a fixed amount periodically post retirement. Of course, SWPs are the option, but as I said, I would encourage highly 10 to 15, maybe 15 to 20 max should be you can say invested in equity as well, which should be good enough to give you a standard stable income and would still be giving you a decent return, which is good enough to beat the inflation. And that is what is very important in this kind of a situation. So how to select the mutual fund for your goals? Of course, a few criteria: time horizon, target return over investment of the goal. You do a reverse planning, as I said. Then the market dynamics, of course, then the asset allocation, what exactly it is there. Mutual fund categorization, I told you various types today. And then mutual fund selection process, deciding on the portfolio percentage. Of course, reviewing and tracking it. So there are many other scenarios where you could invest other than these 8 scenarios. It can be saving up for your travel, which is a short-term goal, of course. We want to go around the world. We want to go abroad in 2 years' time, 3 years' time. You do a reverse planning that is the expected amount, and then you start investing and saving for that also. Of course, people say liquid fund. I would say even an equity fund would be a good option for that point of time. Of course, 2 years is a very short horizon. But yes, a portion of that still can be done over there. You want to save for a house down payment in future, you can go for equity mutual funds for a 5 to 7 year time. So the best approach is list out your goals, list out your risk appetite, and list out your time horizon. These are the most important times when you have to make any investment decision. Because what all do we seek from an investment? Returns, dividends, it should be liquid, the risk should be managed, it should be flexible, and of course the tax benefit should be there. As usual, always mutual fund investments are subject to market risk. Read all scheme-related documents carefully before investing. So before I give you the carry-home gyan for today, I like to push on the 3 points that I always say. For investing in market, you need to have the 3 C's: clarity, competency, courage. Clarity about your goals, about your risk appetite, about your time horizon. Competency, knowledge. एज एन एंटरप्रेन्योर भी जब भी हम सोचते हैं ना, सर आप क्या बोलते हो, मैनेजमेंट भी आनी चाहिए, फाइनेंस भी आना चाहिए, लॉ भी आना चाहिए, कंसेंट भी आनी चाहिए, ये स्टाफ मैनेजमेंट भी आनी चाहिए, एचआर भी आना चाहिए, क्या क्या करे डेंटिस्ट अकेली जान. एन एंटरप्रेन्योर नीड्स टू लर्न ऑल थिंग्स, not necessarily need to do all things. Self-employment is a trap. Don't get into that everything you need to do yourself. In short term, staff problem, understandable. But otherwise, build teams, build structure, build strategies, build systems, build, you can say, functional things for those dreams or those goals. So remember the 3 C's: the clarity, the competency, and of course the courage part. So before you invest in mutual funds, consider the following: investment goal, risk appetite, and time horizon. When you decide these 3 things, choose a fund depending upon the fund's investment style and strategy, how it matches your goal. Uska past performance kya raha. Of course, past performance is never an indicator of the future performance, but yes, it can be still a good benchmark. The fund's performance history, as I said, the fund manager's track record, and of course, the big thing, the expenses associated with the fund. If you're going in through a fund manager, it is a regular fund. If you're going your own way directly, it is a direct. A direct fund and a regular fund may have a difference of 1%, but in the long run, even 1% can lead to a difference of, if you're going for 25 to 30 years time horizon, for example, for retirement corpus, even difference of 1% would lead to difference of 2 to 3 crores in the end. That is the amount of difference a regular and a direct mutual fund can. Of course, equity investments are ideal for long term. Choose a SIP route for a disciplined, dedicated, and an averaging out investment. Of course, liquid short-term debt funds, I don't believe in them, but they can provide more stable returns. You can choose these for lump sum investments for till the time you are not sure when the market is behaving erratically. Maybe then you can slowly transfer from there to equity funds. But for any equity, you should not be even looking at those funds for 5 to 7 years in terms of withdrawing. In terms of tracking, track them every 3 to 6 months for sure. So when I say don't look at them, I don't see that invest and forget. You still need to keep, you can say, tracking them, but forget about withdrawing from there. So how to select a mutual fund scheme? Again, an infographic for you, setting up the goals, setting up expectations, the right mix. The right mix is how much debt, how much equity, 80 minus your age, 100 minus your age, or 80 minus your age. Normal is 100 minus age, 80 minus age is for Indian conditions. That is a safe bet. Whatever the difference comes, that is to be invested in equity. For example, if you're 40 years old, 80 minus 40, at the age of 40, your 40% should be invested in equity. As you grow older, 50, 60, your portion of investment at your old age also should be some portion into equity. As I mentioned, even when you're retiring at 60, 80 minus 60 is 20. Your 20% should, at that point of time, should be there in equity. Equity is your long-term bet, long-term friend. Don't look at it in short term. सर ने बोला था फंड में लगा दो, 2 साल हो गए मेरे को फंड में ग्रोथ नहीं आई. नहीं आएगी, नहीं आएगी. पहले तो जब आपने लगाया था मार्केट वाज ग्रोइंग, you bought at a higher thing. Now it is on the downside. You're buying at a lower one, but still अभी आपका टोटल कॉर्पस रेड में ही होगा पिछले 1 साल में अगर आपने खरीदा. But that's perfectly okay. When this market is going to boomerang as per its cycle, which it does, तो आपको रिटर्न मिलेगा. Then of course shortlist of funds. Look at every website will have 10-year, 5-year, 3-year returns, which were always there in top 20. Insane amount of information available on that. If you're not competent enough, gather information, gather knowledge. My channel has a lot of videos for guiding all of you. Unfortunately, people don't open up the channel. It's not my mistake. I'm anyways going to limit my involvement with the, you can say, all these things after 30th June. Till the time I'm having the FB lives, and of course, there will be a lot of changes after 30th June in my involvement with the public aspect. Because if the effort is not being valued, there is no point in continuing with the effort. It is too long a rope that I have given already. So I cannot keep on wasting my precious time. I call that my time is very precious because the amount of the things I accomplish, because I do have my personal goals as well. How long can I go on serving the community when the community is itself not responding? I don't look at the handful of people who watch my videos regularly or know who can say give me a feedback regularly. It is made for the larger chunk of audience. Even the 1500 in my group can't watch my videos, so then there is no point in creating such a content. Already the content is more than you can say 700 hours. So if somebody starts today, he'll need about a year to watch the whole content. Exactly 2 years back, I started my YouTube channel on 1st or 2nd of June. Of course, it's been a long journey, close to 500, not even five, not yet 500, but close to 500 videos right now. Of course, a few are in the SD and the HD view, but still, otherwise, also singularly speaking, there are close to, you can say, 325 plus videos, and that is a huge number. But the effort needs to be valued. If the effort, I can't keep on hammering, please watch, please watch. It is not for me. I already know these things. I'm taking out this time from my family time after 8 o'clock to help you out, guys. But how many people watch? Hardly a handful. So there is no point in putting in the effort. And of course, these things are not going to change drastically. And I'm going to, because I don't leave things unfinished. So that is the reason I have not stopped it in between. But this is the 22nd. 4 more to go after this, and I'll be done, of course, with the lives. And of course, I'm not extending these lives anytime after June 30th. So before investing in your fund, this is the moral today. You must identify your goals. Your goals is an essential step for the right scheme for you. And of course, we need to remember that risk and return are directly proportional. If you want more return, you have to put in more of risk. So balance out your desires for returns against the you can say tolerance for risk in that part. Of course, you should know how long to hold on to a fund. Once you select a good fund, it is very paramount to your overall investment portfolio success. Of course, what goals you have set. It may seem daunting, but yes, we all take one step at a time. 2 years back, if I had thought that I would beat the camera and be in front of the camera every other day, I would say, I'm sorry, you're joking. My line was simple. I hate the camera and the camera doubly hates me back. I've been never found in my family photographs as well. Hardly there. But the thing is, I've overcome that, and in front of you, the results are in front of you in 2 years. So again, if you seem like a daunting task, do a little research, understand your objectives, understand your goals, have some vision. And then, of course, you can end up with a great thing. So once you have so many options, you are bound to get confused, but that is what the 3 C's are required: clarity of the goals, competency of the financial knowledge, and of course, the courage to invest, beating against the conservative approach. Not for a full term, for a balanced one, of course. So balanced, keep all the factors in mind, and of course, you can choose the best fund investment to scheme. As I said, there is a part 2 to this as well, but it will all depend upon the audience interest. If I find the good, you can say, audience engagement in this video, I'm surely going to do a part 2. But if not, I'll do a different topic. So this is the bottom line, you can say, one slide which summarizes all: short term, medium term, long term. High risk credit funds for short term, multi cap funds for medium term, and mid cap and small cap for long term. Medium risk bonds, funds, ultra short duration funds for short term, for medium term, balance advantage, and multi cap for long term. Of course, low risk are the overnight funds or the liquid funds for short term, gilt funds and short duration for the medium term, and the large cap funds for the long term. So this is in one, you can say, short summary. Identify what is your time horizon, identify what is your risk potential, and accordingly you can choose. Now, once you pick on, let's suppose मेरा medium सा risk है, time horizon medium सा है, so this is the thing to go for you, balanced advantage funds. Say my risk is low, my risk appetite is low, and my you can say time horizon is long. Go for large cap funds. This is the way you. This is in one slide can tell you the categorization. Once you have that, pick out the best large cap funds in the industry. Read about those funds. You will always have a top 5, top 10 list. Read about them, and then go for it. This is the simplest and the shortest way to start. There can be nothing more simplified than this if you want to. But if you still don't intend to watch, it's your choice. Thank you so much for being a patient audience. Of course, this is my WhatsApp community. If you want to be added there, please send me a message. This is the 6th group is on, and I plan to finish them at the 6th group because it is easier for me to take a session. I take the session in 1 and forward it to 5. WhatsApp allows 5 forwards. I am not going to extend it beyond 6. Of course, if the groups get full and the audience is interested, I may remove out inactive members from there. So this is my YouTube channel. As I said, close to 500 videos now, almost 480 plus. So this is my you can say link by my name only, youtube.com/c/Dr. Bhavdeep. If you forget, go to the YouTube and search Dr. Bhavdeep Ahuja, you will find this. This is my social media presence. My name only, Dr. Bhavdeep, Clubhouse, Instagram, Facebook, and you can get in touch with me there. To send me a valuable feedback on my number, on my page, on my YouTube channel, or wherever you're watching. Bouquets and Big Bath both will be welcoming you, my dear. And thank you once again. And I stop my share for acknowledging the visitors on my page where this session is happening, and of course, taking up any questions if there are. So, hello, Dr. Bhavna Lokwani. Hello, Dr. Ramchandra sir. Hello, Dr. Dhagash. Hello, Dr. Shreyash. Hello, Dr. Nimish. Hello, Dr. SP sir. Hello, Dr. Rajesh Tangrani sir. So, I hope, friends, this session was of some value to all of you. And if it has been, do let me know. Of course, depending upon the audience interest on the YouTube channel or on the Facebook engagement post, I'll decide what the second part to this, or of course, I'll shift on to a different topic. So thank you so much, guys, for watching. And I hope this session was helpful to you in some regard. Bye-bye. Take care and have a great weekend.